Yo, what's up, guys?
We're live. What's up?
What is going on?
We should keep this little thing unmuted so we can.
I can hear it from my end.
Okay.
I can hear it from my end. So I just would rather not have it over our talking. So, CleanSpark's Q4 2024 earnings call, also known as fiscal year Q1 2025. If you're a sadist, we are not sadists. We are going to do what people normally do. Love you, CleanSpark. Thank you for sponsoring the show, but please fix your accounting. A few things before we start. As always, Penny Ether, fastest hand in the West, quick on the draw with some of the statistics we should see coming out of the, or some of the financials coming out of the earnings. Going to jump into them myself when we do the call, try to aggregate them so we have some analysis after the fact. But per Penny Ether's Twitter account, adjusted EBITDA. Oh, we're not starting yet. Adjusted EBITDA coming in at 55.8 mil, all in cash hash cost at $35.70 per petahash per day. Big drop from Q4's $45 per petahash per day. And they also got $42.5 million from gain on Bitcoin collateral. So it looks like CleanSpark putting some of that Bitcoin treasury to use, reaping some yield. SG&A decreased by $1 million. So definitely more to poke through and to look at from their financials. These are just first takes from Penny Ether. Seemed like pretty good quarter for CleanSpark so far. Be curious to see what's going on with revenue. Also, would be curious to see if they have any updates from some of the facilities that they purchased last year. But Charlie and Will, any quick thoughts before we get into it?
Penny's going to jump on with us.
Penny!
Penny's here. I mean, I don't know if everyone who's in the audience has like seen an earnings call before. This is not a normal like interview style. This is where we listen to the presentation from the C-suite and take questions from the investing audience. Any other context you guys think is important to give?
Hey guys. Hey guys.
Howdy, Penny.
Hey, how's it going?
Hey, so let me just do this real quick before the call starts. But I have a sheet and I just plug in all the numbers to get an idea of like what's changed. And SG&A was the concern for me last quarter. If you guys remember, it kept going up, but this time it went down a little by 1 million. But their hash rate went up, so that will drive down hash cost. And also they've been increasing their efficiency. They have tons of S21s now. I think they've been swapping it out, so their hash cost went down. From what I have, I just look at the SG&A cash expenses. That's all the professional fees, payroll, G&A, but I take out the non-cash stuff like stock-based compensation and biz dev and litigation stuff, and those also all went down. So I take that all out and I come up with a number, and it's around whatever I said there. Was it 35?
Yeah,
35.70.
Like
Yeah. So that's great because in real world Q2 it was 43 or 44, and then real world Q4 it went to 45, and now it's down to 36. So sorry, 35.70. So I was saying, I think they might get 35 this quarter, but definitely, later in this year, I think they could get it down to like 30-ish or maybe even lower. I don't know. So that's good to see. And in terms of like mining, sorry, what's up?
Huge drop. That's a crazy reduction.
Yeah, it's great. Their
and that's largely just driven by the S21s, right? Because their SG&A didn't really move that much.
Well, their SG&A stayed flat relative to last quarter. So, but the other thing I noticed was that 42.5 million or something.
Yeah, the Bitcoin yield.
The Bitcoin collateral. Well, you can't call it Bitcoin yield. That means something else. It's a yield from Bitcoin, I guess. So I'm curious what that is. It's in other income, but it does hit their adjusted EBITDA. But I kind of split up the adjusted EBITDA to see how's their mining business, and then that's one number, and then they have this other income there too.
Really quick.
The call's starting, so
let's do that.
Penny, stay on if you would like, please. We'd love to keep chopping it up once this is over.
If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. And if you'd like to withdraw that question, again, press star 1. Thank you. And Barbara, you may begin your conference.
Thanks so much, Krista. and thank you for joining us today for the first quarter fiscal year financial results call for CleanSpark, America's Bitcoin miner, covering the period from October 1st through December 31st, 2024. Our press release was issued about 30 minutes ago and is available on our website at www.cleanspark.com. Additionally, the 10-Q will be filed shortly. Today's call is also being webcast, and a replay and transcript will be available on our website. On the call with me are Zach Bradford, our Chief Executive Officer, and Gary Vecchiarelli, our Chief Financial Officer. Keep in mind that some of the statements that we make today are forward-looking and based on our best view of the world and our business as we see them today. The statements and information provided remain subject to the risk factors disclosed in our most recently filed annual report and 10-Q. We will also discuss certain non-GAAP financial measures concerning our performance during today's call. You can find the reconciliation of non-GAAP financial measures in our press release, which is available on our website. And with that, it's my pleasure to turn the call over to Zach. Zach.
Thank you, Barbara, and thanks to everyone for joining us as we review CleanSpark's performance for the first quarter of our 2025 fiscal year. Before diving into this quarter's results, I'd like to take a moment to discuss our strategic positioning in greater detail. As a vertically integrated, pure-play Bitcoin mining company, we operate at the crossroads of Bitcoin, energy, operational excellence, and capital stewardship. This strategic positioning has enabled us to become the largest producer of Bitcoin in the U.S. and the world's largest publicly traded pure-play Bitcoin miner. We firmly believe that Bitcoin is the only truly scarce, decentralized, and permissionless store of value and medium of exchange, a belief reinforced by its growing adoption. At CleanSpark, Bitcoin is central to our capital strategy, driving our revenue as a pure-play miner and serving as the largest asset on our balance sheet. Our decision to aggressively hold Bitcoin has proven highly rewarding, with significant value appreciation over time. Our perspective on energy also sets us apart from much of the industry. Unlike others, we've adopted a broad portfolio strategy, expanding across 4 states and 31 mining facilities powered by abundant energy in net export states. This energy profile, combined with our commitment to operational excellence, has made us an industry leader in uptime. While I will discuss our growth strategy in more detail later, one thing is clear. The regions we have strategically selected will more than support our expansion. Being an industry leader doesn't require topping every important industry metric. We are the only operator ranked in the top 3 across key measures of total hash rate, fleet efficiency, marginal cost per Bitcoin, total uptime, and Bitcoin HODL. This consistency has propelled us to achieve escape velocity, driven by both scale and grit. And as we proceed down the path of 50 exahash and beyond, every additional exahash beyond our quarter-end position of 39.1 further enhances our operating leverage and margins, delivering these gains straight to the bottom line. Simply put, we are positioned to mine more Bitcoin more profitably over the long run. A key milestone this quarter was securing a $650 million convertible bond, a significant achievement for our company. Unlike our competitors, we have taken a different approach and used the proceeds to invest in our growth and capital strategy. While Gary will provide further details later, it's important to highlight that our path to reach 50 exahash by the first half of 2025 is fully funded, without relying on equity to fund that growth. We expect to achieve this target solely through greenfield construction and expansion of our sites in Georgia, Wyoming, and Tennessee, a natural extension of our proven land and expand strategy that has driven our success thus far. We've laid the foundation to continue our growth with maximum efficiency, and now the road ahead is ours to shape. With our expertise, strategy, and relentless drive, I have no doubt that our team will not only meet, but exceed expectations, setting new benchmarks for success. With this foundation in place, let's take a closer look at the numbers. Our first quarter revenue was $162.3 million, representing a 120% growth compared to the same period last year. We closed the quarter with net income of $246.8 million, or 85 cents per basic share, while our adjusted EBITDA, a key measure of operational efficiency and financial strength, grew to $321.6 million, setting a new benchmark for the industry. While Bitcoin's price appreciation during the quarter was a contributing factor to our strong performance, it was not the sole driver. Our success is the result of our best-in-class Bitcoin mining operation, disciplined capital strategy, and long-term view of Bitcoin as a strategic asset. Unlike others who sell-mine Bitcoin immediately, our strategy of holding self-mined Bitcoin on our balance sheet, coupled with world-class operational execution, continues to be a key differentiator in delivering these exceptional results. During the quarter, the average price of Bitcoin exceeded $83,000, reaching a peak above $108,000, where our marginal cost per coin was approximately $34,000. This is a $2,000 improvement from the prior quarter. Meanwhile, our total Bitcoin in treasury stood at 9,952 at the end of the quarter and reached 10,556 as of the end of last month, demonstrating our ability to outpace the increasing global hash rate and mining difficulty. We now hold one of the largest self-mined Bitcoin treasuries in the industry. Every Bitcoin was mined right here in America by American employees using locally sourced power that supports rural communities, reinforcing CleanSpark's commitment to responsible growth and operational excellence. Turning now to our fully owned and operated infrastructure, our team not only met but exceeded our 37 exahash target, closing the first quarter of our fiscal year at 39.1 exahash, solidifying our position as the largest Bitcoin mining operator on U.S. soil. Our fleet efficiency stood at 17.59 joules per terahash at quarter's end and has since improved to 16.15 joules per terahash as of January 31st, making our fleet one of the most efficient in the world, a metric we expect to continue improving in the coming weeks. Our strategic presence in energy-abundant states strengthens our ability to scale efficiently. By all measures, this was an exceptional quarter, one that sets the stage for our next major milestone, 50 exahash. The foundation for this growth was laid in January of last year, when we secured 60,000 S21 units with a strategic option to acquire an additional 100,000 units at the same low price. This commitment gave us a significant competitive advantage in scaling efficiently over the past year. Building on that success, we expanded our investment in efficiency 6 months later with another order for 26,000 S21 XP immersion units, the most efficient model to date, again securing an option for an additional 50,000 units. This structure enables us to deploy new highly efficient machines in alignment with our energization capacity, ensuring immediate productivity and eliminating idle assets. With these units secured and financing in place, we are advancing greenfield development and facility expansion across 5 sites in 4 states, positioning us to achieve 50 exahash in the first half of 2025. Our option contract also provides the flexibility to scale beyond 60 exahash at a cost of $21.50 per terahash, which is significantly below the spot market, where prices are currently more than 37% higher. The infrastructure required to achieve the additional 10 exahash necessary for our mid-year target is already sourced, including transformers, power distribution, low-voltage components, and additional immersion cooling infrastructure, like those successfully deployed in Cheyenne, Wyoming, and Jackson, Tennessee. These projects underscore 2 key points. First, the proven performance of our most advanced S21 XP immersion units. And second, the operational efficiencies we continue to unlock with our cutting-edge mining environments. Construction is already underway in Tennessee, Wyoming, and Georgia, and we will provide updates as additional megawatts and exahash come online. While M&A is not required to reach 50 exahash, we remain disciplined in evaluating strategic opportunities. In a bull market, acquisitions often come at a premium and can be capital destructive. However, we continue to assess opportunities selectively, particularly those involving companies with strong power contracts but lower efficiency fleets. Other targets may include small-scale sites where owners face capital constraints in upgrading their fleets and lack access to next-generation hardware at competitive pricing. For long-term expansion beyond 50 exahash, we may also explore greenfield projects with extended lead times that require substation construction, projects we can develop to CleanSpark's high standards. Additionally, as some operators pivot from mining to high-performance computing, we may see opportunities to acquire Bitcoin mining specific assets at attractive valuations. In summary, we remain focused on disciplined growth, operational efficiency, and strategic expansion, ensuring we maximize shareholder value as we scale towards 50 exahash and beyond. Over the years, we have refined our approach and proven that operating CleanSpark-owned miners in CleanSpark managed racks maintained by CleanSpark employees is the most efficient way to deliver on our commitment to operational excellence. This fully integrated model not only optimizes site performance, but also mitigates the counterparty risks that have challenged the industry, risks that were not always fully appreciated at the time. Expanding on that theme, I want to address another model that introduces similar counterparty risk, partnering with the artificial intelligence and broader high-performance computing sector. While some of our industry have pursued a speculative approach to HPC, repurposing a Bitcoin mining facility for high-performance computing is far more complex than it may appear. These deployments require extensive customization, integration, and optimization, not just at the hardware level, but also across software and physical infrastructure to meet the increasingly sophisticated demands of AI and enterprise computing. These challenges have a direct impact on both revenue generation and profitability. By contrast, Bitcoin mining remains an efficient, proven, and scalable business model. We can bring a Bitcoin mining site online and start generating revenue within months, whereas a fully developed HPC site can take 2 to 5 years, not including the time and cost required to secure high-quality, long-term customers. At CleanSpark, we remain disciplined in our approach, focusing on high-return, strategic opportunities that align with our core strengths. As we evaluate emerging technologies, we will continue to apply the same rigor and operational excellence that have defined our success in Bitcoin mining, ensuring that any expansion into adjacent markets is both measured and value accretive for our shareholders. And now I want to take a few moments to address the significant shift in sentiment we are seeing in Washington, D.C. regarding Bitcoin. Over the past 4 years, we've built our business in the face of meaningful regulatory headwinds. While this presented challenges, it also strengthened our resilience, operational discipline, and strategic focus, ultimately positioning us well for more constructive regulatory environments. Since the November election, that environment has begun to shift. President Trump has expressed consistent support for our industry, reinforcing his commitment through key policy positions and regulatory appointments. One of the most pivotal developments came on January 24th, when the Securities and Exchange Commission repealed SAB 121, an accounting rule that discouraged banks from offering digital asset custody services. This repeal marks a major turning point for Bitcoin regulation, clearing the path for major financial institutions to play a more active role in participating in the Bitcoin ecosystem and broadening access for institutional and Main Street investors alike. In addition, we are encouraged by strong legislative leadership in Congress. Two of the most vocal advocates for our industry, Senator Lummis of Wyoming and Senator Hagerty of Tennessee, have been appointed to the Senate Financial Services Subcommittee on Digital Assets. Their deep understanding of our industry will be invaluable as lawmakers work to establish a more balanced, responsible regulatory framework for Bitcoin and digital assets. Beyond regulation, energy policy will also play a critical role in shaping the industry's future. As Bitcoin mining and data center expansion drive new demand for electricity, energy markets are naturally experiencing upward pricing pressure. Given that electricity is the largest component of our direct costs, any policy initiative aimed at reducing energy prices will have far-reaching implications for our business. President Trump's stated commitment to make the United States the global center of Bitcoin mining signals a potential shift towards more energy-friendly policies, an outcome that could enhance both industry growth and U.S. competitiveness at the global stage. We will continue to monitor these developments closely and remain engaged with policymakers to ensure that our industry has a seat at the table as these regulatory and energy policy decisions unfold. On Monday, January 27th, our management team, alongside employees, families, and friends, gathered at the NASDAQ market site in New York to ring the opening bell, marking the start of the trading day and celebrating a milestone of 5 years in the making. We were there to commemorate the 5th anniversary of our uplisting to NASDAQ, a moment made even more meaningful by sharing it with many of the people who have worked tirelessly and sacrificed to build CleanSpark into what it is today. But the truth is a bit more complex. This celebration wasn't just about our 5-year milestone. It was also about resilience. When we uplisted 5 years ago, the COVID-19 pandemic put our opportunity to ring the bell on hold. Missing that moment with our team was a deep disappointment. But if there's one thing we've learned at CleanSpark, it's that setbacks are often just delayed victories in disguise. As a student of philosophy, I draw inspiration from Marcus Aurelius and his writings in Stoic philosophy. As a management team, we've embraced many of these principles in leading CleanSpark and have worked to instill them as a core part of our culture. One passage has always stood out. The impediment to action advances action. What stands in the way becomes the way. That mindset, grit, perseverance, and the ability to turn obstacles into opportunities defines how we operate. It has shaped our approach to scaling CleanSpark into a repeatable, scalable, and durable Bitcoin mining business. So instead of dwelling on what we missed, we refocus and move forward. And standing on that NASDAQ podium 5 years later, it felt less like a delayed celebration and more like the culmination of everything we've worked towards. But it also represented a new beginning as we continue on this journey at scale. That feeling was reinforced as we spent time in New York meeting with investors for Capital Markets Day, where we shared our vision for the future and explained why the path to 50 exahash and beyond is wide open for CleanSpark. Now, before turning things over to Gary, I want to take a moment to recognize the exceptional team behind CleanSpark's success. As we outlined before, we set a target to reach 37 exahash by the end of the calendar year. Not only did our team deliver, they exceeded expectations, surpassing 39 exahash before the ball dropped in Times Square on New Year's Eve. Standing on the NASDAQ podium, my thoughts turned towards our teammates working in Nevada, Wyoming, Tennessee, Georgia, and Mississippi. Some of them may not have even had time to watch the ceremony because they were already working towards our next target, 50 exahash by mid-year. So when I rang the bell, I rang it for them. Bitcoin mining may not have traditional customers, but the great irony is that it may be one of the most people-centric businesses in the world. CleanSpark's success is built on the talent, dedication, and relentless drive of our people. And as it always has been, human capital remains our greatest asset. Now I'd like to turn the call over to Gary for a more detailed review of our financial results and a look at our balance sheet. Gary?
Thank you, Zach. As Zach mentioned, our first fiscal quarter was spectacular for CleanSpark. Let's dive directly into the numbers, which I'm excited to share with you. Our revenues for the quarter were $162.3 million, an increase of $88.5 million or 120% over the same quarter last year. This increase was primarily driven by an overall increase in average Bitcoin price. Of importance, year over year, we produced only 4% less Bitcoin compared to the same quarter last year, despite block rewards being cut in half this past May. We are almost at the same number of Bitcoin produced as pre-halving due to our increasing exahash and increased fleet efficiency from our best-in-class miners. It is also important to note that our average revenue recognized per Bitcoin produced in Q1 was almost $84,000, which is an increase of 130% over the same quarter last year. When compared to the immediately preceding fourth quarter, our revenues increased 82% due to the increase in Bitcoin prices and our Bitcoin production. For comparison, we produced 480 or 33% more Bitcoin in the first quarter than the fourth quarter, and the average revenue per Bitcoin at our wholly owned sites increased 38% between the periods. CleanSpark has industry-leading uptimes typically in excess of 98%. However, this past quarter, we saw a slight temporary decrease in our uptime to 94%. This was driven by several factors. Foremost, the quarter started with limited exahash online because of a hurricane. Second, we moved approximately 80,000 miners as a result of our fleet upgrades and racking at new locations. However, I want to point out that while we saw a slight dip in one of 5 key industry metrics, there's an inverse relationship as we saw significant gains in efficiency and Bitcoin produced, as well as reduced cost per coin. This upgrade resulted in significant ROI as our fleet efficiency dropped from 21.94 joules per terahash to 17.59 joules per terahash, or 20% between Q4 and Q1 alone. And as I mentioned earlier, our Bitcoin production rose 33% between periods. Looking at our margins, our gross profit increased by $47.1 million year over year, with a profit margin of 57% for this quarter. When compared to the immediately preceding fourth quarter, our gross margins increased $59.9 million, or 186% during the periods. While you have heard us mention several times that our fleet efficiency continues to increase, the power of scale is demonstrated here through our margins. For example, our cost to mine a Bitcoin was $36,250 in the fourth quarter. However, in the first quarter, we saw that cost per Bitcoin decrease to approximately $34,000, which represents a quarter-over-quarter favorable improvement of about 6%. Our strategy to maintain one of the most efficient fleets in the world, combined with best-in-class uptime and operations, is translating to significant margins, and all while the global difficulty has increased during the same time frame. This quarter, we recognized net income of $246.8 million, which is a significant improvement from prior periods. This increase was primarily driven by the growth in the fair value of our Bitcoin and a gain related to Bitcoin returns as a result of our paydown of the Coinbase line of credit. This gain continued with $321.6 million of adjusted EBITDA for the quarter. As I look over the numbers, I want to provide some additional color. Our cost of power for the first quarter was 4.9 cents a kilowatt hour. This was higher than our cost for power of 4.4 cents in the same quarter last year, and slightly higher than our fourth quarter cost of 4.8 cents. While our cost of power per kilowatt hour in this quarter is running higher than in prior periods, our margins are far exceeding this increase, thanks to the efficiency of our fleet and on-site operations. Additionally, with Bitcoin mining economics better than prior periods, we have more headroom and capability. This allows us to run our fleet through periods where the cost per kilowatt hour is elevated, because we do not manage the business to a price per kilowatt hour, but rather to a margin and profitability on a per coin basis. This is why you hear us say we have reached escape velocity and always prioritize cash-on-cash returns. With respect to our indirect costs, in the first quarter, our total professional fees, payroll, and G&A expenses totaled approximately $34.8 million. This is a decrease of $5.8 million, or 14% compared to the preceding fourth quarter. This decrease was attributed to lower professional fees of approximately $1.8 million, primarily due to the transactional fees we had in Q4, related to M&A activities. Additionally, payroll expenses decreased 16% or $3.9 million quarter-over-quarter due to year-end bonuses recognized in the fourth quarter. Lastly, our G&A expenses saw a slight decline of about 1%. While professional fees may fluctuate with activity related to M&A and financing transactions, I'd expect indirect expenses otherwise to be relatively flat or increase only a nominal amount for the remainder of the fiscal year. With the combination of the increased margins and relatively flat indirect expenses, this is an example of how CleanSpark is delivering operating leverage at scale. Next, I want to talk about the balance sheet, liquidity position, and our larger overall capital strategy. We believe our balance sheet is one of the best in the business. We have almost $2.8 billion of total assets, almost half of which is liquid in the form of cash and Bitcoin. As you are aware, we issued a $650 million convertible note transaction, which we closed on December 17th. The industry's only 0% coupon, 100% up with stock buyback. With the net proceeds, we purchased a cap call, which made the effective conversion premium 100%, or $24.66 a share, and we bought back approximately 11.8 million shares of our stock. The stock purchase is reflected as treasury stock, and our total outstanding shares have decreased as a result. Additionally, we used $50 million of the proceeds to pay off the line of credit with Coinbase, and that capacity remains available for us to use at our discretion. We're proud to have closed this offering, which more than fully funds our growth through 50 exahash and beyond. In addition to funding the growth to 50 exahash, share buyback and cap call, the remaining proceeds will allow us to keep adding the Bitcoin we mine per balance sheet for the near term. Beyond our expansion efforts already underway, we remain well positioned to continue executing on opportunistic acquisitions. Importantly, this offering provides our stockholders with greater clarity on near-term share count, given our ATM offering was completed in early November, and we have no immediate plans to commence another equity or ATM offering, as the capital received from the convertible notes sufficiently covers our near-term strategic objectives. As of the close of the quarter, we had over $1.2 billion of liquidity, which includes approximately 276.6 million cash and almost 10,000 Bitcoin. You may have heard us speak about our conservative approach to debt on our prior calls. I expect that we will continue to be cautious in further leveraging our balance sheet, as we will evaluate our balance sheet health on a net debt basis to ensure we have proper liquidity to operate the business and service near-term debt at all times. We continue to have discussions regarding non-dilutive or less dilutive options, which is reflective of the maturity of our capital strategy as we build out our capital stack and utilize our very profitable operations and clean balance sheet for accretive growth opportunities. Turning to our Bitcoin treasury, it's important to note that it represents the fourth largest position amongst public corporations in the world, trailing only a handful of competitors and larger than the holdings of major corporations such as Tesla, Coinbase, and Block. In contrast to many of our peers, our Bitcoin HODL was mined exclusively in the US by CleanSpark at a significant discount to the spot market price on the back of our best-in-class operations. Our net debt approach to the balance sheet gives us far more flexibility when it comes to cash management and funding future growth. As impressive as our Bitcoin stack may be, we want to put it to work productively to help fund the business. We are actively building an institutional-grade Bitcoin treasury team and strategy with the goal of preserving capital, opportunistically managing cash, and driving a lower cost of growth capital in non-dilutive ways. Because of Bitcoin's unique place as an emerging global financial asset, we can adopt best practices in treasury management from traditional finance while harvesting volatility for our benefit. We are currently engaged with high-quality counterparties to evaluate a holistic approach in utilizing our treasury to meet business needs, and we expect to go live shortly while ramping up activity over the ensuing quarters. As we mentioned earlier in the call, we want to invest in ourselves and the business. After all, why buy Bitcoin at $100,000 when you can mine it as low as $34,000? With that, I'll turn the call back over to Barbara to open the floor for questions.
Thank you, Gary, for that very detailed financial overview. We'll now open the floor to questions from the analyst community. Krista, please provide instructions and manage the queue for Q&A session.
At this time, I would like to remind everyone, in order to ask a question, please press star one on your telephone keypad. We'll pause for a moment to compile the Q&A roster. Your first question comes from the line of Mike Colonnese with H.C. Wainwright. Please go ahead.
Good afternoon, guys, and congrats on a really strong quarter here. Thanks for taking my questions. Gary, you alluded to some of this on your prepared remarks, but just curious if you could provide a bit more color here. So you guys have built out a nice reserve of Bitcoin over the past year, now have over 10,000 Bitcoin on the balance sheet. Any further details you can share in terms of what your Bitcoin treasury management team is strategizing to put those coins to work, be it the counterparties, current market yields you're seeing, and what portion of the treasury you'd be willing to dedicate to yield generation strategies?
Yeah, thanks for the question, Mike. So we are in the process right now of gathering RFPs, requests for proposals to evaluate counterparties and look at the various options. I don't want to commit to a strategy. In fact, I'll refer you to what we said last call, where it's going to be a crawl, walk, run type strategy. And ultimately, we have a number of options available at our fingertips. So we'll see how those RFPs come back and really what the transaction opportunities look like. But ultimately, I don't think in the near future we're going to leverage, 100% of the HODL balance or, put 100% of it to work. We're just going to slowly kind of leak into it, and we'll have more to report on in future quarters.
Got it. Fair enough, Gary. And Zach, maybe for you, this one here. How should you think about the cadence of hash rate growth from the 40 exahash deployed today to your mid-year target of 50 exahash? I know you guys are working on a number of projects across the portfolio, so it'd be great to get a better sense as to when you expect those projects to energize.
Yeah, appreciate it. And thanks for always joining the call, Mike. It should be a pretty even cadence over the next 6 months as we roll things out. So I don't think it'll be that chunky. It'll just kind of be a little bit added every single month as we move along through the period. So as we mentioned, the majority of this, well, all of it is happening essentially in our backyard. And so these are projects at existing sites for the most part, with a few greenfield sites added on, that we're basically rolling into things. So again, this is going to be a very natural cadence for us just to add that remaining 10 exahash over the next couple months.
Great. Thanks again, guys.
Hey, thanks, Mike.
Your next question comes from the line of Brian Dobson with Clear Street. Please go ahead.
Hey, thanks very much for taking my question. So you alluded to your capital allocation strategy, which is shown through your, call it the fruits of which are shown through your relentless sequential improvements. But do you think you could speak a little bit to your management philosophy that drives that improvement and separates you from your peers?
Yeah, Brian, thanks for joining us. I'll jump in on that one. So, we live at the intersection points of, so many things ultimately results in the profitability of mining Bitcoin. And, living at the right point of that crossroads is ultimately how we look at it, where we don't feel the need to pursue a number. And I think that that's a differentiator in our management team. We haven't held one thing out and said it's the most important, because we actually believe that the intersection points are the most important part. So, as we pursue these KPIs and, ultimately how we see it's critical, we think our secret sauce is really the grit, perseverance, dedication, of our people. And I think that as we go through that, it's about instilling the same values that we've had since really the founding of the company. We're ready to work hard, all of us top to bottom, and I think that shows through ultimately in the results.
Yeah, thanks very much. And then do you have any comment on the potential for in-kind exchange in terms of driving yield on the HODL?
Yeah, so look, I think that the applications that are on file for the ETFs are a really positive thing overall for Bitcoin. And it'll be interesting to see how that really affects it all. But, For us, we're really just focused on managing our HODL balance. We are looking at potentially using the ETFs as part of that treasury management and the derivatives that are around those products as well. But I think it really remains to be seen how it's going to impact us directly, other than just a general adoption of Bitcoin overall.
Yeah, thanks very much.
Your next question comes from the line of Brett Knoblauch with Cantor Fitzgerald. Please go ahead.
Hi, guys. Thanks for taking my question and congrats on the quarter. Maybe just looking, and I know you guys have a lot on your plate for 2025, but kind of looking beyond 2025, I guess what type of power capacity do you have in your pipeline? And maybe in which states would you look to expand? Is it maybe within TVA, where I know you guys are very positive on?
Yeah, so there's the ability to expand in really all the regions that we're operating in. I do expect that you're going to see the majority of the growth, happen in both the Tennessee and Wyoming areas, because those are the areas that frankly have the most blue sky to them. We've been expanding for a long time in Georgia and that region, and so I think that's where you should expect to see the majority of it. Frankly, we're incredibly excited about those utilities, and frankly, their willingness to lean in and understand the value of interruptible loads in their utility. So that willingness to continue to educate themselves, but also both those regions are ready and willing to adopt energy tariffs that benefit Bitcoin mining due to the interruptibility of those loads. So that's likely to be our focus in the coming year.
Appreciate it. Maybe just one follow-up. I think if I look at kind of like your OpEx for this quarter, professional fees, payroll, G&A, all declined, and I think your hash rate improved somewhere around 40% quarter over quarter. Can you just maybe talk about the strategy you guys deploy in managing OpEx while delivering such strong growth, and I guess how sustainable is that, and is there any incremental OpEx needed to drive you guys to 50 to 63 and beyond?
Yeah, thanks for the follow-up, Brett. I think ultimately, we just built this foundational, this foundation of just indirect expenses, right? And we just have a very strict budgeting process. We watch every dollar that goes out, and really where we're investing is on the operational side. And given the fact that our cost of capex is one of the lowest in the industry, I mean, I'll remind you that we have contracts out there for $21.50 a terahash right now, which is at least 30% lower than what the fair value of those machines are. Having that focus really on operations really allows us to have every exahash that comes online almost drop to the bottom line, because we don't need that incremental corporate overhead to support $1 of additional revenue. So that's why I feel comfortable, the indirects being relatively flat for the remainder of the year, and really the only wild card is in the professional fees, and that depends on the activity of the M&A landscape.
And Brett, I'm going to add one more thing, because I think it's part of our management strategy is in how we think big about what we do. We have a portfolio of properties, but in building a portfolio, we had to solve unique problems that we prepared for. And basically, we built on our ability to expand, early on. So we're leveraging technologies such as remote management and other things that are the same types of technologies that large, hyperscale data centers are utilizing to keep their headcount down and reasonable. And so we do that across the entirety of what we do, whether it's on the overhead side, whether it's on the operational side. We've always been in an expansion state, but we wanted to plan that expansion for the future. So I truly feel that we have built a scalable business at the current size on the operations, but it's because of the thought process that occurred, 2 and 3 years ago.
Appreciate the answers. Thanks, guys.
Your next question comes from the line of Tyler DiMatteo with BTIG. Please go ahead.
Hey guys, thanks for taking the question. Appreciate the time here. Zach, I'm curious, you guys have done a really nice job kind of growing exahash over time, getting to the 40 exahash mark. But as you think about going to 50 exahash and then ultimately to 60 if you exercise the option, does going from say 40 to 50 and 50 to say 60, is the implementation different, or how could it be different given that you now have a bigger scale and you look to put those rigs to use? I'm curious just maybe how you think about the actual execution and implementation of that now that you have 40 exahash online.
Yeah, I'm going to point to a phrase we've continued to use, and that's repeatability. So everything we've done is to basically build a blueprint that can be stamped out on a repeat basis. And our goal, just like all things done at scale, is as the process becomes more and more repeatable, that we find every opportunity to drive costs down while increasing quality. And so that's been our goal. We're incredibly excited, and we've mentioned this multiple times the last few earnings calls about the technology that we're deploying on the immersion cooling side. We are seeing immense operational efficiencies and a lot of operational leverage around the way that we're deploying those, and we see it as the right blueprint to stamp out. So as we march from 40 to 50 to beyond, we see ourselves using a successful and proven blueprint that we're able to restamp on a repeat basis.
Yeah, I just want to add to that as well. I mean, we have a track record of growing exahash, right? A year ago, last January 2024, we were just a little over 10 exahash, and as we sit today, we're 40. So we have that proven excellence to be able to execute on this, and we're very confident we'll be able to get there.
Okay, great. Thanks, guys. And then my follow-up here, realizing that you have the fixed price option at the 2150 for the next level of growth and rigs. I'm curious though, how would you describe kind of the rig market dynamics? I know you pointed to, I think it was 37% higher potentially for some of the rig pricing. I guess just broadly, Zach, how would you describe some of those dynamics? And really, what are you seeing as you kind of look to keep an open mind in terms of the growth profile of the business?
Yeah, I think that as we see it, it's all about relationships. We've got deep vendor relationships, not just with a single vendor, but across multiple parties that we believe will allow us to always maintain the competitive pricing. Jerry talked about track record just a moment ago, but our track record is to, on a repeat basis, set the floor price of the rigs as new units come out. But it's also to not jump just because something comes out, which you saw in our activities 2 and 3 years ago when rig prices weren't where we thought they should be. So that the benefit of the scale we have, and frankly how far ahead we've gotten for the majority of this industry on an exahash basis, means that we have the opportunity that time presents where we can be selective about our timing. I think it's one of the things that we've done amongst the best in the entire industry is not trying to dollar cost average into our equipment, but instead is to relentlessly drive to the low cost, high quality model. And we just intend to do it again. So regardless of where the market shifts and moves to, we've got, through beyond 63, our price certainty is already there. Everything beyond that is somewhat speculative, other than, we would just look to continue to leverage our relationships to always, be best in class.
Okay, great. Thanks, guys. Really appreciate the time.
Thank you.
If you would like to ask a question, please press star 1 on your telephone keypad. Your next question comes from the line of Stephen Glagola with Jones Trading. Please go ahead.
Hi, Matt, Zach, Gary. Thanks for the question. You highlighted the benefits of increasing scale to your margins long-term in your prepared remarks. And as you approach 50 exahash, is there a point where you think increasing scale becomes less of a focus for the business versus looking to maybe increase the free cash flow generation and productivity of the assets you currently have, and also potentially returning capital back to shareholders? Thanks for your thoughts there.
Yeah, I think that I'm going to use a phrase again on, having achieved escape velocity. That's where we are at right now in the business, is for every exahash we add, it does produce free cash flow that does flow to the bottom line, ultimately does benefit the shareholders. I would, to make a comparison, if you look at most of the industry, Based on our math, there's, less than 5 companies that even have the opportunity to achieve this same scale, which will ultimately result in positive cash flows. The balance have a lot to do to catch up. So again, I'm going to point back to what I said earlier, we're time. There is going to be time to push the gas pedal all the way down, and there's going to be a time to let the car coast. And frankly, it's likely going to be driven by input cost of materials, whether that's the servers, whether it's the infrastructure. And, rather than speculate about timing right now, it's about how well are we positioned to react to market dynamics. And I would say we're positioned amongst the very best. And so, and I think that comes in multiple forms. Again, I'm going to point to vendor relationships, the cost certainty that we've already locked into place, but also the fact that we don't have to push to catch up, because there's a point that we've arrived at where the cash flows are already flowing in a way that's, benefiting the shareholders, but also allows us to continue to grow through those cash flows. I'm going to turn to Gary to see if he has anything else to add on that.
Yeah, I would just reiterate comments on optionality, right? That's how we built the business. And I think that, we would love to look to return capital to shareholders, but most importantly, we've got to shore up the balance sheet, which again is extremely healthy, right? And as we increase our cash flows, it's just going to provide us more optionality as to whether we reinvest in the business because the ROI is greater there, or if that means that we need to return capital to shareholders through a stock buyback or some other means, and that's the best use of the capital. We've said that, probably been a while since we've talked about it on a call, but we absolutely would put that. But again, we can't do that unless we have, significant margins and a healthy balance sheet. And I'll tell you that's why these fleet upgrades are so important, because the efficiency increased favorably by 20% between the 2 quarters, and our total cost or our cost to mine, direct cost to mine per Bitcoin dropped by $2,000 a Bitcoin, which only adds to our cash flow. So it's those types of investments that we think are not only going to pay off in the short term but long term. And again, ultimately, once we have that fortified balance sheet and we've taken advantage of as many opportunities, media opportunities as we can, we'll look to find other ways to return capital to shareholders. And our last point, we bought back almost 12 million shares as part of the convert. And, big reason for doing that was to really invest in ourselves, because, we have this clear path to 50 and even beyond. And we feel good about where we're going. So really betting ourselves at this point, we think that's going to translate to shareholder returns.
All right. Thanks, Gary, and thanks, Zach. Appreciate it.
Thank you.
Your next question comes from the line of Bill Papastasiou with KBW. Please go ahead.
Yeah, good evening, gentlemen, and congrats on the quarter. For my question, we're just hoping you could add some color on how you're weighing the growth strategy beyond 50 exahash. The quarter clearly demonstrated an attractive operating profile. And where you guys stand today at 40 exahash, you're not very far from being the leader in the space in terms of scale. So how important is it in the road ahead to scale, just given that all your peers are moving to AI HPC? Seems like it could be a low-hanging fruit opportunity for investors that are looking for a high beta play on Bitcoin.
Yeah. Hey, appreciate you joining the call. Good question. We love when we hear someone pivoting to HPC because it means global difficulty goes down. And so as we continue to scale in that environment, it just means the piece of the pie that we're getting of daily Bitcoin rewards, which again are scarcer every 4 years. So now is the best time to acquire it. It means our piece of the pie gets bigger. So yes, continuing to scale is important, but it's not an end all be all, right? Again, we don't grow to grow. We grow because it's strategic to do so, and it means that we have more to gain. Again, at the point we're at, every exahash we add is dropping Bitcoin or dollars to the bottom line. And so as long as that continues to prove, we will continue to grow responsibly in the ways we do.
Appreciate the color. Thank you.
Thank you.
Your final question comes from Greg Lewis with BTIG. Please go ahead.
Hey, thank you, and good afternoon, guys, for taking my question. And apologize if this has been asked. I've been having some issues this afternoon. Zach, you touched on it on the Capital Markets Day. Really around your ability to create partnerships in the community, and just as we think about what's happened over the last couple of years, in companies like CleanSpark really building, and helping communities across Georgia and beyond, and the success that we've seen with other miners in Texas at ERCOT. Has there been any shift, or maybe maybe not that there's inquiries now for CleanSpark delivering Bitcoin mining solutions in some of these rural areas that you're looking to target, but as the tenor from potential small utilities or customers or municipalities, how has that kind of shifted? And as you look out, over the next 12 months, I have to believe with the current administration that's a huge tailwind as you look to kind of continue to expand your infrastructure footprint. Could you kind of talk a little to that? Thank you.
Yeah, we've shifted into an environment where instead of people being worried about the big bad Bitcoin miner that's going to come to town, we get inbound inquiries where cities now understand the economic benefit that we can bring. Whether that's through the tax base or whether it's through an employee base. There's different parts of the country that are frankly looking for different things. That. So, and what I will say, and specifically commenting on, small utilities, that's where also we're seeing a lot of benefit, because these small utilities, they've made 50 and 100-year long investments over the past, several decades. And when they have idle assets that are no longer producing revenue, they start to lack the ability to continue to upgrade their equipment. And so, we can be the answer to that. We can come in, we can use idle assets in communities where, the freeway didn't go through and everything went around. We can make a real impact in rural America. So I would say that, when our name goes into these communities, and I think I'm proud that it is our name going in, we're getting welcomed with open arms, because these communities are ready to, reap the benefits of what Bitcoin mining really can bring to rural America. It's one of the things we're incredibly proud of. And partnering with utilities is a big part in the education. Having a large load can be scary to a utility, but their willingness to listen and understand the interruptibility of that, so they can continue to serve all their citizens while driving down their costs and increasing their revenue, is the key message we're driving forward. So I'm incredibly happy and optimistic about what I expect to see, really in the heartland of the U.S. as we continue to grow.
Great to hear. Thank you very much.
We have no further questions in our queue at this time. Barbara, I'll turn the call back over to you.
Thanks again to everybody for joining today's earnings call, and we'll look forward to staying in touch with you and sharing future results with you in the coming quarters. Stay tuned for more achievements from CleanSpark, America's Bitcoin miner.
Ladies and gentlemen, this concludes today's conference call. Thank you for your participation, and you may now disconnect.
Fellas, 1 second here. Need to get this annoying music off. Oh, it's gone. Whose is that? Is that Penny? Is that you, Nick? What's that beeping?
That was me. Sorry.
Okay. No, all good. All right. Charlie, Nick, Penny. Nick and Penny, thank you for joining. We got Nick Luxor, Nick Hansen, CEO and founder of Luxor Technology here. We got Penny Ether, one of the best independent analysts in the game. Pretty strong showing for CleanSpark in that Q4. Want to highlight a few things before we kick it off. Number one, CleanSpark stock jumped in after hours following the earnings call, or during the earnings call, I should say. I'm going to share my screen really quickly. It sold off when the earnings call started just a little bit, and then in after hours trading, it jumped to a high of $11 USD, not a all-time high, but a local high, and it's been chopping kind of between 10.81 and 11 cents, and now it's at 10.38 dollars per share. So obviously, markets reacting pretty favorably. Love to have first takes from y'all. Penny, we'll start with you, and then Nick, we'll jump to you.
Yeah, sure. So, during the call, I was digging into what this Bitcoin, the collateral, the 42.5 million. I think it's just they post collateral to Coinbase, and that the value of that Bitcoin changes, and that's what it's marked down as. So they have a line of credit with Coinbase, and Coinbase says, put a bunch of Bitcoin in an account so that, if you can't pay us back in cash, we have your Bitcoin at least. And they require a certain amount. It's like, up to like some certain percent drawdown. It's in the filings. So I think that's a nothing burger. I don't think they got like yield from Bitcoin. I don't know if they sold covered calls or they lent it out. I don't think that's the case. I think I just jumped the gun on that. So, I wasn't sure what it was and I dug into it. But overall, I was estimating between 50 and 55 million in adjusted EBITDA from their mining operations, and it came in at 55 point something. So, it hit the higher end. It came 55.8. So it's a solid quarter. It's good to see that SG&A didn't increase because it went up from Q2 to Q3, but now it went down just a tiny bit. So their hash cost went down as a result, and, they're generating cash, and now it's just up to, it does their value. Do you think their valuation is justified based on the amount of cash they get now and could get in the future, depending where Bitcoin goes? So I think it was a solid quarter. Good to see costs go down. They made money. That's about it. Nothing too surprising.
Nick, anything to add on to that?
No, yeah, I agree. Pretty strong. Not a lot of huge surprises in there. I feel like they, execute on what they were supposed to execute on. Yeah, SG&A stayed relatively stayed fair. And that's always something I like to look at. And otherwise, yeah, I thought it was a good quarter. I think they did what they said they're going to do, and it looks like they're executing well.
Yeah, SG&A staying pretty flat per what you said there, Penny. I believe it was only like $1 million difference for cash-based SG&A. Meanwhile, revenue for the quarter was up bigly to 162 mil. And then you gave that 55 mil EBITDA number just then. Another big thing that you pointed out, Penny, is it looks like their hash cost for this quarter, and this includes everything, right? This is all in hash cost, is like $35 per petahash per day versus 45 for the prior quarter. Is that right?
Yeah, that's what I have. And it's just based on what their monthly operations. You see what their joules per terahash is and what their exahash is, and you compute all the amount of work they did. So it's not going to match like their official numbers, but it does include everything. So if you look at just the cost of revenue, which is like their electricity and also their hosting, it's comes to 23.57. And if their direct comes to 23.57. And if you include SG&A, the other cash expenses, it's 10.42. And another thing that I include that they wouldn't is their dividend. So they paid themselves 5 million, and I count that as a hash cost because if I were a shareholder, it's a cost that I incur.
Right.
So yeah, when you add that all up, it's 35.70. And last quarter was 45.
Yeah, which is great, and that's entirely driven by this deployment of S21 units. Their joule per terahash average across their fleet is now 17.59 joules per terahash, getting on the lower end of some of the public miners. We're seeing a lot of those fleet efficiencies drop over the last couple of years. I mean, over the last few quarters, I should say. I think Iron was the first one to really have a substantial drop. They reported like 15 joules per terahash last quarter. And
Yeah,
now most of the other miners are catching up.
Iron's funny because I don't think they put the joules per terahash in this monthly thing, but I assume it's 15. But another thing that's helping CleanSpark potentially, we won't know until the 10Q, is, I mentioned they have self-mining and they have hosting. Like they pay to host their ASICs, and the split, they pay more for the hosting. It's like it was like 6.5 cents a kilowatt hour last quarter, and it's around this. It's between like 6 and 8 cents. It fluctuates. Whereas their own energy expense is just below 5. So if they shift more of the hosting away to self-mining, that helps a little bit. Last quarter, they were at like 84% of their kilowatt hours were self-mining. So, this quarter, maybe it went up to 90. I don't know. We'll see.
So you think maybe some of that's driven by the Tennessee acquisitions and the Wyoming acquisitions?
Or
Like
just,
maybe.
shifting away from hosting in
Well,
general.
that's what I
just
mean, though. Like maybe they're, deploying rigs that they formerly hosted to those new sites. I mean, we don't
But
know
even
for
their
sure.
existing sites, they could just be taking away the miners, just not doing hosting anymore, just cutting those back and then installing the new S21s in their self-owned capacity. So if you look at it like from a hash rate perspective, it would be a lot more hash rate self-mining than hosting, and
Right.
probably the same for kilowatt hours. But we'll see. They split it out in their 10Q. Their 10Q is really good, by the way. They have a lot of details, and it's pretty clean.
And
And it's like the pure play mining, so it's like pretty simple.
Is that up yet?
I didn't find it when,
Okay.
like 10 minutes after they released, but I didn't look again because I was digging into the Bitcoin collateral thing.
Right.
Yeah, Penny, maybe you mentioned earlier, but and maybe I missed it, but I think you noted in the side chat that their net revenue from Bitcoin, their Bitcoin treasury was like close to their mined revenue this quarter. Was
Yeah,
that is
yeah.
that
So
correct?
that's the first. I think it's not from their Bitcoin treasury. I think that was collateral they posted for the
Okay.
50 million line of credit with Coinbase, and then that collateral that they posted, it changed in value because it's Bitcoin, and so that's what that other income is. So they have like the statement on their sheet will be change in fair value of Bitcoin, and that's for the Bitcoin that they're holding, but Coinbase is holding this other Bitcoin as collateral, and that also changed in fair value, and so I think that part went into the other income thing. So I don't think it's from any treasury. Some of it could. I don't think it's from any treasury strategy. I don't think it's from like selling calls or anything. I think it's just the change in value of collateral they posted, if that makes sense.
Gotcha.
And they also,
That
it
seems
seems
pretty
like
significant.
if they made that much money, like from some Bitcoin treasury strategy, they would have like been pretty vocal about it, and it would have been a
Okay.
big thing.
Okay,
So
I
I
was
think
yeah.
I
I
think
just
it's
wanna
just like an accounting thing.
Gotcha. Yeah.
So another thing I wanted to touch on was a kind of a few qualitative aspects of that call. Really good commentary, Penny, on some of the quantitative, and we'll get back to some of those. But they always bring up, obviously, in these calls, like expansion plans, things like that. They want to give investors a little nibble, little breadcrumb trail for what's going to be coming in the future. One of the things that I've always felt that's interesting about CleanSpark is they never really promise too much in terms of forward guidance for how many megawatts they want to put online or what they expect to see in terms of like, we're going to add this much onto this site. But they kind of work in the shadows and then end up dropping these press releases of big mergers or rather acquisitions of mining sites. I mean, that's kind of how CleanSpark made its name earlier in like 2023 or so. So they kind of burst onto the scene as one of the leading miners from scooping up distressed assets and other Bitcoin mines. And they kind of hinted in this call that they might be evaluating some other acquisitions in 2025. They said maybe they'll greenfield. They kind of played it a little cagey in terms of which one they're going to do. But if, past is truly prologue, then I would assume that we should see more acquisitions this year, which is crazy because if you go to their website and look at their Bitcoin operations, I just want to list off some of the places where they have operations right now. So their co-location, to what Penny was saying, is in Messina, New York. In Tennessee, they are in Jackson, Lenoir City, Limestone, Maynardville, Crossville, Decatur, Jellicoe, Oneida, New Tazewell, didn't even know that was a place, Winfield. In Georgia, they are in College Park, Norcross, Washington, Sandersville, Dalton, Baxley, Vidalia, Swainsboro, Twin City. In Mississippi, they are in Vicksburg, Meridian, Wiggins, Clinton. In Wyoming, they're in Cheyenne. In Utah, they're in Woods Cross. In Nevada, they are in Henderson. I am about to, that is dizzying. I have
Johnny Cash over here.
This one a question I want to direct to Nick, and then Penny, I'd love for you to jump in here too. Is there an argument to be made that they are spreading themselves too thin here? That is a lot to manage across multiple different states.
Yeah, that's a lot. I didn't know. I knew it was a lot. I knew they were probably the most disparate group, but I didn't know it was that disparate. So for folks that don't know, running a mining center, you you have a bunch of machines in there, and they're not always just going to run 100%. It's not a money printer that prints money 100% of the time. Things go up, things go down. There's weather events. There's all sorts of stuff that go into running a mining site. So managing a site like that is really, really complex. Well, managing a single site, not terribly complex, especially if it's a couple megawatts. There is something to be said for, a single site with a single topology, looking at like a Riot, for example. Like basically the majority of their hash is in 2 or 3 places: Corsicana, Windstone, and then they bought that site in Kentucky.
Yep.
And they probably have other sites that I'm not aware of off the top of my head, but the majority is there. So you have site techs, you have everybody there that knows the software for that particular site, the weather in that particular site. All those things are somewhat uniform. So it removes a lot of operational complexity. You got to now monitor weather. If for CleanSpark, you got to monitor weather in Georgia and Texas and Nevada and Kentucky and all these different places, and also your power pricing in all those areas. So it becomes a management. Definitely increases the management cost of a facility, or not even a facility, of a company of that size. So now, are the returns diminishing? That's a great question. I guess if you're, how do I say this? If you come to a site and if you come to a facility and you demand a bunch of power, the next person, their power price is probably going to be a little higher, and then the next is going to be a little higher than that. And so, your marginal pricing increases as more demand in a particular site, wherever that happens to be. So you reach this threshold point where it doesn't make sense to expand anymore because the price has increased. So then you start looking for other facilities and other sites where, that type of demand hasn't occurred. I guess, yeah, you probably have to do some really complex modeling around how is it, or how do I say, how do you factor in the marginal increase in production into your marginal increase in cost to add that production? It's got to be a very complex model. And it seems like they've kind of figured it out for now. Maybe there's a point where I don't know what kind of software and management they have internally. I imagine there's a bunch of software behind the scenes kind of keeping an eye on all of this stuff, because you have that many sites. You can't just have a person running a bunch of monitors looking at the trading view of mining per se. You have to have a bunch of automation. I don't think they really went into that. I don't know much about like what kind of automation they run to manage a fleet of sites like that. But yeah, there definitely is added operational complexity, and I'm sure they're thinking about that as they look to add more sites in different regions and manage those sites. There's reasons that they do this. So yeah, hopefully that's a I don't know. It was a little bit all over the place of an answer, but
that was
yeah,
good color. Penny, anything you'd add to that?
I kind of forgot the original question, but and I have to run in like 3 minutes. But
Okay,
I think it was.
Never mind about that.
No. I have a really good point here.
Okay, make your point, but then I want to ask you about converts. Go for it.
Oh, okay. Well, they spent $100 million of cash in the quarter, right? So that's roughly their burn rate. And if you look at how much cash they have on their balance sheet, it's like 280 million. And if they're just purely hodling, their cash is going to go away at 100 million a quarter, roughly. So I'm wondering, I don't know how much leeway there is for them to expand and buy new sites, because I think you mentioned like, oh, they come out with a surprise of a new acquisitions or whatever. But I don't know how much cash they're going to, they have.
Right.
They have like 8 months of cash at this burn rate if they want to continue 100% hodl. So either expect more convertible notes or ATM, or expect them to just fill in the capacity that they have now.
All right. So speaking of converts, Penny, before you go really quickly, would just love some input from you on pros and cons of that approach versus the ATMs. So obviously miners issue an at the market offering, investors bellyache about dilution. You've pointed out that some people say, yay, convert, no dilution, and it just delays the dilution potentially until the maturity date. And I also wonder how much of this is like cashing in on a industry trend a la MicroStrategy and some of the other miners who did this to buy Bitcoin. So like, what do you think about the convert strategy, and any thoughts there in terms of whether or not this is net positive or net negative compared to just doing an outright ATM?
Oh, I think it's it's like doing an ATM at the conversion price if it ends up converting. So for CleanSpark, This is their December 13th announcement. They did 650 million, 0% coupon, and the conversion price is $14.79. So if the share price goes to like $16 or whatever, then let's just say the notes convert. It's as if they did a $650 million ATM and they sold all the shares at $14.80. It's roughly like that. And they did the capped call thing as well, which means if the share price goes even, I have to look into that. I've actually, I can't think off the top of my head. I just have to run. But so it's pros and cons to that. It's like you're locking in what the potential quote ATM price is because you'll dilute at that conversion price of the notes versus an ATM where it's just open and they can dump shares. And if their share price doubles, they can hit the ATM at those better rates. So it's just like risk reward. And if there's a 0% coupon, it's kind of cool. It's kind of just like you get the money up front and it's the convertible note holders. It's up to them to make money from it, or so they make money from arbitrage, from volatility, from trading the gamma. So I think there's pros and cons to either one. The capped calls part is like slightly more complicated, but basically they pay so that if the share price goes way higher, it limits the amount of dilution. I have to dig it. It's been a while since it's like been in my head. It's kind of been squeezed out by other stuff, but I did a post on it. And that's just sort of them betting on themselves. It's as if they bought if they bought a call spread, like long at 15 and short at 25 or whatever. It's like long at the conversion price and short at the cap price. So they're just betting on themselves. Like if you bought a call spread on them, it's like it's the same thing for them. They're doing it for themselves. That money they spend up front and it's gone. So if their share price doesn't go up all the way, they just burnt that money. But if it does, then they save money from not having to dilute as much in that scenario.
Fantastic. Thank you, Penny. Appreciate your time, man. Love it as always. Everyone go follow this madman on Twitter at Penny Ether.
Thanks, man. See you guys.
And, yep. Take it easy.
Peace.
All right, gents. Anything else we want to talk about? I kind of liked how, and this is not just because they sponsor the show, although we were very happy they do. I kind of liked Zach's points during the call about kind of keeping focused on Bitcoin mining when every other miner is chasing the AI and HPC golden rabbit, potentially very lucrative. But he made the point that's maybe somewhat optimistic. They love it when any miner says we're evaluating HPC because that means the difficulty will grow more slowly. Just curious about y'all's thoughts on that. Is it wiser to kind of stay focused in this heyday or the early heyday of the AI HPC revolution? Are they maybe missing out? Maybe is there an argument here to be made that they don't really have any options to cash in on this because they don't have the massive sites that Riot does, right? Or that some of the other miners do, because that's where the real golden nugget is for some of these deals, right? If you've got 100 megawatt blocks and you can have a hyperscaler come in and just buy those assets. What do we think about them staying the course?
Go for it, Nick.
Okay, I'll go. Yeah, it does seem like it does seem like that they're using it as a positive. It's a feature, not a bug. They're like, we can't really expand into AI, so good thing everybody else is. So we don't. It reduces the network hash rate. So that's good for them. And I mean, they can point to the rest of the pubcos and see like the ones that had a very aggressive AI strategy. They were somewhat punished during when Bitcoin was running. The others ran a lot more. And then when there was the AI scare, like DeepSeek and all that stuff, those got like Corsair kind of got crushed during that time. They've recovered since, but Corsair didn't run when Bitcoin was absolutely running in Q4, where the other miners did. And so they can point to that and be like, hey, if you're investing in a Bitcoin miner, invest in a Bitcoin miner. Don't invest in like a hybrid HPC because Bitcoin miner is really good at mining Bitcoin. AI company is really good at doing AI. If you start mixing the two, you become bad at both. And there's maybe some, maybe that there's some, there's some truth to that. So whether they can or cannot actually expand into AI, I think it's probably for the best, at least for the investment profile they're trying to provide to the market, to stick to a pure play miner. If I want to invest in AI stuff, I'll go buy NVIDIA, or if I want to invest in AI infrastructure, I'll go buy Digital Realty. Doesn't make sense to like invest in a company that doesn't really know AI, kind of knows mining, and is now distracting themselves from both.
I mean, I agree with this. I mean, we've talked so much about pure play versus AI hybrids, Colin, and I think everyone on the show. My thought is it's pretty clear that the majority of other large miners want to be this hybrid model, and that would leave CleanSpark as one of the largest, I think maybe the largest pure play, which is highly differentiated. Now, I mean, I just from a personal standpoint, like I'm very confident that there will be lots of shareholder value created from AI hybrid strategies. But I think it's much less clear what the competitive advantages are when you do that. Like it's like really hard, I think, because it's so new, and it was as a a year and a half, 2 years ago, not really a narrative like it is now. It's like not very clear, I think, how you execute on that. CleanSpark has successfully executed on like the most crazy, 2 or 3 years of expansion ever.
Yeah.
And so like lean into that. That makes a lot of sense to me. And I'm a bit of a romantic. I like the pure play miners. So, simple as that.
Yeah. I'll go ahead, Nick.
Oh yeah, no, I was just 100%. I think the pure play miners make the most sense for somebody that wants to invest in miners, and AI companies, and are the ones that if you want to invest in AI, go invest in an AI company.
Because like if you're trying to invest in AI, you like, and you're a Bitcoin miner going into that, now you compete against like pure AI play miners. So it's like I don't really know how you just because I don't study the AI data center model and it's kind of new.
Yeah.
It feels a lot like I think I've used this analogy before, like back when rigs were crazy hot in like 2021, and everybody was racing for this, those particular mining rigs for delivery months out. And like some people did well, but it was just not a high confidence decision in retrospect. So I see similar gold rushes as having similar potential traps trying to compete for the hottest market. So we'll see.
Yeah, and for an industry that is no stranger to hype waves, the AI and HPC one seems to be one of the biggest. Going back to the idea of CleanSpark being conservative with its forward guidance for megawatt expansion, I think that this kind of is in line with that conservatism in the sense that they are not going to try to dive into something that they don't really understand. And some of the promises that you see from some of these Bitcoin miners who are trying to do AI or HPC business lines, they're pretty crazy, especially if you look at like the annual or monthly recurring revenue that they'll extrapolate out based on one good month of AI stuff. I'm not going to name any names, but you can go poke around 10Qs and investor presentations and you can see what I'm talking about. A lot of Bitcoin miners are making promises that the industry is yet to see and the market is yet to see whether or not they can actually keep it. Another thing on this with regards to CleanSpark staying in its lane, I liked how Zach pointed out about their convert, their like $650 million convertible note deal. They didn't do what Marathon did with that and go out and buy Bitcoin. Like they're going to use that for actual expansion. I get that the hot thing to do might be to just follow the micro strategy or strategy. But at the end of the day, like imagine like a gold miner raising a bunch of money and then just buying a stockpile of gold, right? Like you would not, if you were an investor in that miner, you would be kind of nonplussed by that decision, or like an oil producer. At the end of the day, Bitcoin miners are commodity producers. And as an investor, I would want to see capital raised being deployed to further their operations. So I think pretty clear-eyed decision-making over the last month or so, or last few months or so, and a good quarter, better than I think some people expected for CleanSpark here. Gentlemen, any other thoughts, anything to highlight before we wrap up here? We're almost at about an hour and 30 minutes.
I came in a little late to the stream. Did they mention anything about tariffs?
No, they did not. That's a really good point. They kind of just beat the Trump drum in a more favorable way, right? Like he mentioned the repeal of SAB 121. Right, which, like, for people who don't know what that is, it was a Security and Exchange Bulletin that basically said you know, banks cannot custody crypto assets. And now that that has been repealed with the Trump administration, this opens up potentially the floodgates for much more financial inclusion and access on both sides, or going both ways with regards to Bitcoin and cryptocurrency. And so he kind of just said, we really are happy that the new administration is more favorable towards our industry. He talked about how Trump wants to increase energy production in the U.S., drill more oil, produce more natural gas, which should be favorable and for energy prices, right? He kind of just talked about that. Didn't touch on the tariffs. That would have been a really good question from one of the analysts. I mean, what
tariffs
what's your
and
take on?
tariffs and border, like the border increased border inspection rate. So
yeah. So what's your take on this, Nick? As because Luxor has a pretty thriving logistics and ASIC brokerage business. Am I wrong in understanding that? Well, if the machines are manufactured in Malaysia, are they subject to the same?
They're not.
To the
They're
tariff
not.
rate?
But what there are companies we call third-party logistics companies. What they do is they ship them from Shenzhen to Malaysia or wherever, and then repackage them and then send them over. And then that's what, at least in my opinion, that's kind of there's that, and then there's the softgo thing, which we have kind of hammered out, is they're investigating to see if there were softgo chips or if those machines didn't pay the correct tariff. So you basically mark down the value of the machines or something like that. So that's I think why they're being more inspected. Had heard kind of through the grapevine that maybe those all that stuff kind of goes away this week. I mean, it is kind of the end of the week and nothing's really happened. I know there's folks that are still held up in customs now that are waiting, that have been there for months. And just really no response.
Yeah, sorry, to provide some color for people who might be out of the loop here. The Custom and Borders Protection Office has been holding shipments of S21s and T21s for a couple months now, 3 months, depending on who's importing them. We broke a story on Blockspace, I believe in December or in November, about at this point a dozen companies in the U.S. being affected by this, and seems like they're still being held, but you're hearing that this might end soon. Is that right?
That I heard earlier this week that one of the folks that was held up said that they were going to get released, and that they were being directed to get released, but it's now pretty much close of business on Thursday, and no movement. So really, unless it's Friday, nothing really changed. But we'll see. So wanted to hear it. I don't know how that affects a company like CleanSpark, because I imagine they're kind of consistently receiving shipments that need to be cycling out. They've talked about cycling out of their old fleet into new machines, bringing down that joule per terahash number, which is really important to continue to scale and to scale effectively. And so I have to imagine that there is some impact to the underlying business there, meaning delays of upgrades and things like that. So not 100% certain. I don't think they mentioned it. But it would have been good to get a question from them, or get a question or an answer from them on that question, just to kind of hear where I'm sure they were affected. Everybody in mining has been affected in some way, as far as I can tell. And so would be interested to hear kind of where they, if there were any pain points for them.
Yeah, 100%. And if I recall correctly, with our reporting, we talked to a handful of public miners. I don't believe CleanSpark said they were affected, but some were. So it would be really great to get that cleared up. I'm sure that hopefully that's coming soon. But on that note, gentlemen, I think that does it for a little post-call analysis. Nick, appreciate you joining as always, man. I hope you're having a good winter. I don't know if y'all got snow up where you are, but down here.
It has been, the winter here in Seattle has been oppressive this year. It's usually not great, but this year it's not been only wet, but it's been really cold. It's just been, we don't get into the 20s that frequently, but it's just been 20s for weeks. And I know that's nothing for you guys that, Denver boys, but, or I guess you're not in Denver anymore, but it just seems like the Pacific Northwest has been cold.
Yeah. Well, we're cozy maxing this week. That's for sure. All right.
Cozy maxing.
Nick, Charlie, thanks for joining y'all. And everyone who tuned in, really appreciate it. We do this for the fans. We do it for the fam. And we hope y'all have a good week. We'll see y'all later.
All right. Take care, guys.